So good afternoon, everyone. Welcome to our fourth Virtual Accounting Research Seminar. For those of you who are attending the first time, my name is Giovanna Michelon, and I've been organizing this event series together with Mark Lathworky and Joachim Gassen. I do not want to take much of Victor's time, but I need to make a couple of announcements before we start. First of all, we have a list for the new speakers upcoming in June, and it's available on our website. The speakers are, in order of appearance, Chris Chapman, Christine Cooper, Thomas Beauvau, and Kirsten Becker. So thank you for the speakers for accepting our invitation, but also thank you to those of you who have put forward nomination, because those helped us putting together such a great and diverse list of speakers. The second announcement is essentially to thank the colleagues who have stepped up with the VARS organization. Andrei Philippe from ESSEC Business School, who I'm pleased to say will be co-hosting today's seminar with me. And then we have Victoria Cloud from the University of New South Wales in Australia. Yasemin Karaibrahimoglu, I probably have mispronounced her last name. She's from the University of Groningen in the Netherlands. And then we have Irma Malafronte from the University of Roehampton in the UK, and Evisa Mitru from Queen Mary University of London, also in the UK. Victoria, Yasemin, Irma, and Evisa have agreed to help us with the back office of the VARS, which is something that is not visible to the audience, but is also quite important. So thank you to each and all of them for their contribution. Let me just briefly recall the ground rules for the seminar. Participants are to stay muted during the seminar, but they can raise questions via the Zoom chat. Victor will go uninterrupted for about 15 minutes, and Andrea and myself will monitor the chat and then call on participants that raise the question to speak directly. Then after the first round of Q&A, Victor will continue with his presentation, and we will be taking breaks from time to time to take additional questions. So now I'm going to let Andrea introduce our speaker. Thank you very much for attending today.
I just want to say good afternoon, everybody, and to say that my name is Andrei Philippe, and I'm very happy to give a hand for the organization of the virtual seminar. It's a Friday afternoon, and I think it's becoming a habit in a way to go and to assist to this very interesting VARS series, a VARS series that is speaking for the diversity of accounting research in Europe. And it's now the turn to go for experiments this week. So we're going to look at the experiment, and we have as a special guest, and I'm honored to introduce Victor this week. Victor is a young scholar that has just graduated, having the PhD from University of Tilburg, and he's currently assistant professor at the WHU. And he's going to present a paper on public tax disclosure and investor perceptions based on some experiments from a very nice, interesting paper. And I'm very much looking forward to hear from Victor. And with this one, Victor, you have the floor.
Okay, thank you very much, Andrei, for the introduction. Hello, everyone. I'm very excited to be here today, to be part of the EAA VARS meeting and present this working paper. It's titled Public Tax Disclosure and Investor Perceptions. But first, I want to, of course, thank the organization for this opportunity. I think it's really great to be able to present, especially when you're an assistant professor, to present a working paper on this platform. I've really enjoyed the presentation so far. And yeah, I can't emphasize enough how useful it is, especially also not only the presentation, but also the meetings on beforehand, where people sort into private meetings with you to talk to you about your work, and the emails around it, right? So around this date and this presentation, I received various emails with helpful thoughts and comments. So this is quite useful. So first, yeah, Andrei introduced me, right? My name is Victor. I'm currently at WHU in Germany, and I specialize in experimental research. And this is my first tax paper. So I may not be the most senior authority on tax, but I am learning increasingly a lot about tax. And it is piquing my curiosity and interest increasingly, especially public tax disclosure. Now, I have to, of course, mention my other co-authors on the project. That's Bart Dierink, Martin Jacob, Maximilian Muller, and Christian Peters. We have quite a diverse co-author team, both in terms of seniority as well as specialization. And yeah, I also want to mention this is a fresh draft. So this is the first time we're presenting it publicly. We have been presenting it internally, but this is the first time that we are, doing it in public. And we would definitely appreciate any comments that you have in the chat or via email directed to one of us. So in advance, thank you so much for your comments and questions. So let's get started. Now, the main motivation of this project is that there is an ongoing interest and public interest in whether firms are paying their fair share of taxes. And here's just an example of that, where we see an organization called Americans for Tax Fairness, and they often go out and protest and raise awareness for instance, about firms that are not, according to them, are not paying their fair share. So this seems to be on the public's agenda. And with the public, we mean consumers, retail investors, and other members of the public. Now, I found this very interesting. Also personally, I'm from a country in Europe, small country, the Netherlands, and we are notoriously kind of known to help firms manage their taxes a little bit. So I find it very interesting to see that there's such a big public debate, and there has been also for quite a while. It seems to me that, that it's also on the radar of governments and policymakers. Because the public is interested in this, this seems to be on their agenda too, and some of them have been implementing and considering policies that mandate the public disclosure of select tax information of companies. Now, why do they do this? Well, in theory, mandating these types of disclosures of select tax information that could raise a lot of awareness and bring some information at least to the public, like retail investors and consumers. And in turn, the public can then act on it and maybe punish firms that are, well, not paying their fair share, and firms that are paying, and reward firms that are paying their fair share through, for instance, divestments and investments and purchasing their goods versus avoiding purchasing other firms' goods. So this is kind of the setting that we're looking at. Now, to give you a feeling of the type of disclosure that we're looking at in this paper, this public tax disclosure, I would like to start with a question. So before you shoot questions at me, I want to ask all of you a question. So we're going to launch a poll, which I can do here. And I would like to ask you, if you can you tell me which of these two firms pays a fairer share of taxes, according to you? So if you can, tell me which one of these are paying a fairer share. Is it firm A or firm B? And you have information about the profit that the firm is making in your country, the corporate taxes, and the effective tax rate, which is just the corporate taxes divided by profit. So if you can, please let me know which firm is paying a fairer share of taxes. So I'm going to give it maybe 10 seconds or something. So please, if you can, try to vote. Then I'll continue. Okay, so please cast your vote now, if you can. All right, I'm going to close the poll now. So I'm going to share the results. So basically, the results are as follows. Basically, what happens if we put forward select tax information like this, we see that we tend to lean a lot towards firm A, because this firm pays a higher effective tax rate. So relative to the profits that this firm is making, this firm pays disproportionately more tax in a certain country. But the whole point of our paper is actually that this information can actually, does not accurately fully represent the underlying tax reality per se, right? So therefore, this may be a little bit dangerous in some cases under some circumstances to put forward this type of tax information in this shape or form. So just to illustrate that, I have another example. And that example is the case of Australia. Now, in Australia, they actually introduced a policy that mandated exactly this type of disclosure to the public for reasonably sized firms. And here's just an example. I believe this is 2017. So this was mandatory since, I believe, 2013-14 for firms of a reasonable size, so large firms. And you can see that they have to report something like revenues, taxable income, and corporate taxes paid. And you can see that you can really look at, well, how much taxes is a firm paying relative to their profits in Australia. Now, if we calculate the effective tax rate for 2017 in Australia, we get this picture, this frequency graph. And if we would use the same reasoning as the majority of the people in the poll just showed, we could conclude, well, these firms here on the right-hand side, they are fair firms. They are paying their fair share because they pay the statutory tax rate in Australia, right? Now, on the left-hand side, these are unfair firms because they are paying 0% tax of their profits. And in the middle, maybe these are okay-ish firms. They pay some tax, but not the full statutory tax rate. Now, a lot of the firms in Australia, well, a lot of the firms in this particular sample were actually making losses at some point. And it's perfectly legal to use tax loss carryovers to actually reduce your tax burden in a particular year. So if we get rid of those, then actually the picture doesn't look that bad at all anymore. Although, at first we thought, okay, these are really unfair firms. The same argument can maybe be made a little bit for the firms that are paying that statutory tax rate. So in theory, not necessarily in Australia, but in theory, paying the statutory tax rate in a particular country doesn't mean that you've paid the amount of tax in absolute terms that you could have, perhaps, and that you should have. Because we know that firms can actually shift profits or have some discretion where profits end up. So it's a lot more complicated, perhaps, than just relying on this information that you saw in the poll and the information that actually these public tax disclosure companies are actually considering and have been implementing over the past couple of years. And that leads to our main research question, which is, how does public tax disclosure of corporate taxes or select tax information influence retail investors' perceptions of whether firms are paying their fair share of taxes? And before we go to the questions, right, I would like to start with maybe a quick overview of what we actually find. And what we find is that public disclosure of select tax information can blur retail investors' perceptions about whether firms are paying their fair share of taxes. And this subsequently also blurs and affects their perceptions about investing in firms. Overall, our results kind of put forward a cautionary note that the exact policies about public disclosure of select tax information, these exact policies may actually not work as intended. They may actually have the opposite effect, at least when it comes to less expert members of the public, like retail investors. So I think maybe this is a good time, Andre or Giovanna, to go some questions if there are. Go to some questions if there are any.
There are no questions in the chat, but I think
that's really
Andre has one to see whether the rest of the audience warms up in the meantime.
Exactly.
Okay.
So just for the audience to warm up, I was a little bit like, if you can comment a little bit about more about like this concept that is aggressiveness. I'm not familiar, it's not my literature. And I do wonder, like when I read the paper and I looked at this concept of aggressiveness, how much is it important, and what is exactly behind, like, I question, like, maybe again, it's for the fact that I'm not within the literature, but the concept of aggressiveness, like, why does it matter at the end? The so what question, like, for this.
Yes, yeah, thanks for that question. I think it's a good question. I also had to learn about aggressiveness, and so aggressiveness is a term that, to the best of my knowledge, is used in this tax literature to refer to certain tax avoidance methods. Now, for instance, what they say is that shifting profits, for instance, from one country to another, using gaps and mismatches in between countries' tax systems, that is considered a lot more aggressive. That's coined a more aggressive method, which is just a label that they seem to use in this tax literature. While, for instance, more legal, right? Well, perfectly legal, but means such as R&D tax credits or tax loss carryovers, they're considered less aggressive or non-aggressive methods. So there seems to, this aggressiveness to me was like, well, a term that is used in this literature, which we also use because of that. And this seems to be kind of what members of the general public want to assess, want to really, well, that's what we think the ultimate objective should probably be, learning about which tax avoidance methods firms actually use and their aggressiveness. So I hope that kind of clarifies things a little bit.
If I can just jump in, like, on a follow-up, because that's, at the end of the day, raises the question, like, so what? As long as you have, like, you reach your mean, how you reach the mean exactly through more aggressive or less aggressive reasons, it should be, like, in a way, like, irrelevant how you do it.
Yeah, so yeah, it depends, I guess, on what you care about. If you think that that the method does matter, right, then you will probably respond to it and want to learn about it. Well, we see, at least anecdotally, as I just showed, right, that members of the public seem to want to firms to use certain methods over others because they consider that fairer than certain other methods, right? So I think that yeah, to me, when I see the public debate and when I see what perhaps some of these members of the general public care about, there seems to be at least that they care about it in one way or another. Now, whether that's intrinsically or about whether they think that yeah, firms need to pay their fair share, and also why that is the case, of course, you can talk about that, I think, for a very long time. There could be perhaps a more rational reason, or there could maybe be a lot more intrinsic reason. I don't know, actually, but there could be many reasons, I think. And there is a lot of literature on it, as different literatures on it. I had people contacting me already talking about equity theory and about kind of differences between the general public and, for instance, some of the well, the kind of the taxes that they have to pay versus what companies pay, and the discrepancy between that, and that also has to do with income, for instance. So I think that there's a lot of things that you can talk about there.
Thank you very much, Victor. We have that worked, so now we have some questions in the chat. Tim, would you like to turn on your mic and ask your question?
Yes, can you hear me?
Yes.
Oh, hi, Tim.
Okay. Hi, Victor.
Nice.
I was wondering, to what degree do these disclosures, for example, in Australia, substitute other disclosures? Because if I think about how I look at certain companies, I think it matters a lot of what is going on in the company. If I, for example, compare Amazon, who has a reputation for paying low taxes and treating their employees very badly, with maybe Facebook, who's had a reputation for paying their employees quite well and also avoiding a lot of taxes, then my perception of fairness is quite different for these two. So to what extent are these disclosures in a vacuum, and to what extent do they substitute other disclosures? And another question that I had is, so what type of retail investors are you capturing in your experiment? Because I guess that the perception of tax fairness are quite different for Europeans compared to US citizens or maybe some South American citizens. So maybe if you could talk about that a little.
Okay, yeah, thank you so much, Tim. And also thanks for speaking up. Those are really good questions. I hope I will remember them now. So the first question is about are the type of public tax disclosure that we feature, which is the select tax information, are they, can they, we look at them in isolation. Why? Because we run an experiment. So in experiments, that's kind of the whole, benefit and disadvantage of experiments, is that we can control the setting and we can isolate some kind of effect. But I completely agree that, yes, maybe if one firm manages taxes in a very aggressive way and therefore is not paying its fair share, perhaps, then maybe this firm, that is offset by something else, or maybe it really depends on what this firm is doing in other areas or disclosing in other areas even. That is indeed true. And maybe we need to think about that a little bit. I don't really think that is the real focus of the experiment, though. Like, as I said, we want to kind of really look at this in isolation, but I definitely agree that this should probably matter. I hope that's satisfactory. Well, maybe you wanted a bigger discussion about that, but I don't know too much about any spillovers or any that it could also offset other disclosures or things like that. I have not seen anything like that, but if you have seen anything like that, definitely let us know. The second question, and I hope that and now you will see that I have forgotten the second question.
I was asking about the characteristics of these retail investors that you're looking at.
Yeah, very good. Okay, so we, I think we do report that in the paper. So we look at US retail investors. So we probably should be a little bit more, we should probably state that a lot more. And I think it would probably matter. But we mostly look at US investors. So our setting, so we recruit participants in the US at least. So the US general public. Okay. So I don't think whether we can, what do you think? Do you think we can speak to the European investors? I think so, right? But I can see that cultural differences may matter to some degree, for sure.
Great. So now I think I'm going to ask Joachim to ask his question.
Well, thanks so far. So I have a question about so the baseline of a fair share and the anchoring in that regard. So when you talk about a fair share, I instantly think that people will have some fuzzy feeling about what a fair share is, and this is what I label the anchor. Maybe this is not a correct term. And then you seem to assume that by your experimental treatment, this anchor is shifted somehow. And do you believe that this is because there's a misunderstanding? Sorry if I jump ahead here, but if this is a misunderstanding of retailers about the data, or is it that a simple anchor argument that they see that the average effective tax rate is X, and now they recalibrate what they consider to be fair?
Thank you, Joachim. And no problem if you feel like you're shifting ahead a little bit. But to me, when I listen carefully to your question, I think you're somewhat describing what we find. Really, perhaps anchoring is not the word that we would use, but we would use attribute substitution, which I will explain, hopefully. But we think that it's exactly that shift that is really interesting and important, right? Because in the end, these disclosures would want to improve perception information, which would mean that that people uncover more about the underlying tax reality, and that the tax avoidance methods, the underlying ones, map into the fairness perceptions. But we find actually that the presence of this disclosure exactly does the opposite. We find some evidence for that in this experiment. And I think that is kind of what we're doing. That's how I would frame or retranslate what you were saying into what we kind of show. So that's how I would put it. I don't know whether that's satisfactory.
Absolutely.
But yeah. Okay.
Okay, great. I think Jung Jin may have a clarification question that I'm going to allow in this break, and then the other questions that are in the chat, we'll pick them up later, okay?
Okay.
Ying Jun, do you want to make your question? Perhaps I'm mispronouncing the name. I'm just, Jung Jin?
Okay, now I can talk, right?
Okay.
Yeah.
Thanks.
Thank you, Giovanna, for proper pronunciation. Yeah, it does that. Okay, I have a question about the public perception about the tax avoidance. When you talked about the loss forms, it looks like that you presume that there is no group tax conforming tax avoidance, right? Because some companies can reduce the reported earnings. Through that, they can reduce the taxes, right? So basically, many studies has done their research based on the assumption that non-group tax conforming tax avoidance is the dominant one. But actually, recent papers, some very few, but recent studies also starting to investigate how the companies using conforming tax avoidance strategies. So I believe that reported earnings can be very misleading about what really happens for the tax avoidances. But that kind of things has not been much discussed so in previous examples. So how do you think about that? I mean, conforming tax strategies. Thank you very much.
Okay, thank you so much for your question. So I'm trying to understand what you're saying. Now, so I made a disclaimer at the start that I'm learning still a lot about tax, and I have not heard about this term before. Like, I think you said confirming tax avoidance strategies?
Confirming tax strategies, yes.
Okay, confirming tax.
Very similar with the real earnings management to reduce the reported earnings.
I see.
To pay less taxes,
okay.
Right?
Very interesting. That's actually very interesting. I don't think we thought about that in setting up this particular project. I think we went for the most discussed and known cases that we immediately had to thought about.
Yeah.
But I think it's a very good remark. So I think perhaps we should think about these confirming tax avoidance strategies and how whether they could map in our theory or not. That's very relevant. I will definitely take a look at that. Thank you.
Because the reason is that the conforming tax strategy can avoid people's attention by reducing reported earnings, so you do not pay the taxes.
I see. So that works through earnings.
Like everything's fine.
Okay.
Okay. Thank you very much.
I see. Yeah. Okay.
Very good. I think, Victor, now is a good time to go on with your presentation, and then we will take more questions in a bit. Thank you.
Thank you so much. Well, thank you so much so far for the questions. Just to repeat, so our research question is, how does public tax disclosure of select tax information influence retail investor perception of whether firms are paying their fair share? And why is this important? Why is this question important? Well, there has been a policy debate about mandating this kind of stuff for actually quite a long time. So when I started looking into some of this literature and the debates, I found that, people have been talking about this, both scholars, the public, politicians. And the way that I try to simplify it for me, as somebody coming into this literature, is there's a spectrum of things that you can make mandatory as a government and a policymaker. You can have no disclosure, and then maybe at best, maybe retail investors have to look into financial statements and they find a tax rate reconciliation. Or you can have extensive disclosure, and this is maybe think about things like complete tax returns, right? Making that publicly available. And that's a debate that has been going on in the US for quite a while, for instance. Now, it turns out that the debate seems to be very much focused on the pros and cons here. So the pro is, well, we can kind of get a better image about the tax avoidance methods that firms use and their aggressiveness. But the costs seem to be proprietary costs. This seems to be an established counter-argument where basically the more extensive, the more information you actually reveal about taxes, the more tax information you reveal, the more you may reveal sensitive information about a firm that is part of its comparative advantage, or that allows it to actually have a comparative advantage. If that information is out there, then competitors or potential competitors actually know it then and can take advantage of that. So proprietary costs seem to be quite an established counter-argument. Now, when I look at this literature, it seems that there's also something a little bit in between, and that's select public tax disclosure or public disclosure of limited tax information. And here you can think about bottom line tax items or limited tax information, summaries, figures, and the most well-known case, I think, is ETRs and corporate taxes, right? Being publicly disclosed by, for instance, tax authorities. This has been, as far as I know, like the Australian example is an example of that, but I've also seen some debates or proposals being forward to have this form of disclosure in the US a long time ago. So this is something that firms and, not firms, sorry, countries, and this is still on the agenda. And this is kind of the, yeah, this is the form of disclosure that we kind of try to focus on in our project. Why retail investors? Well, it turns out they're important for this setting. And they're important because these types of policies for select tax information that mandates the public disclosure of select tax information, they are likely to target the public. Right? Why? Because these members of the public, they have much higher processing costs. If you have much more extensive public tax disclosure in place, this will unlikely to directly reach these types of stakeholders. So the whole idea when I read the literature is that these types of policies, they seem to allow better access for average, inexpert, unsophisticated members of the public like retail investors. And that should allow them in theory to react on it and act against firms that they think are not paying the fair share. And this in turn, as soon as firms kind of expect this, anticipate this, or experience this, they should increase their tax compliance. At least when I read the papers on this and the debates, this kind of seems to be the reasoning when it comes to these select public tax disclosures. However, and this is where our paper kind of contributes, we think, we have relatively little direct evidence on the actual perceptions of retail investors and other members of the public. While they are the primary driver in case of retail investors for their investment decisions in capital markets. And it would be nice to kind of know, well, how do their perceptions change? Do their perceptions change? And the perceptions are also important because they, members of the public and retail investors, they vote for the politicians who actually are responsible for these policies, who come up with these policies and maintain these policies. And I believe that for instance, in Australia, this seemed to be quite an important, politicians played an important role there as well. We use an experiment now a control experiment, and there's actually two very important reasons why. They're quite good at identifying causal effects. There are other methods, empirical methods, that can get close to that, but I think it's just quite easy to do that in an experiment because we manipulate states and we control the setting so that we can get rid of other influential variables. And in that way, it's much easier, or relatively easy, to identify a causal effect of a policy or an intervention in general. Second benefit is we can elicit people's perceptions, which is typically also unobservable or less observable, less directly observable in archival data. So in this way, we think that experiments can actually complement the existing archival literature on this topic and in this area. This literature, for instance, looks at relationships and causal effects of disclosure policies on capital markets decisions, right? Or these types of disclosure policies. And what we can do with an experiment is, well, before I explain what an experiment do, typically the underlying mechanism is that this flows through the perceptions of investors. So the disclosure policy somehow affects the perceptions and judgments of investors, for instance, retail investors, and that affects or changes capital market decisions. Now, what experiments can do is they can kind of uncover this little piece of the puzzle, which is the first step, namely the presence of a disclosure policy. What is the causal for that effect on that, on the judgments and perceptions of retail investors? And in that way, they complement each other nicely. This together in the literature gives us quite a more complete picture of what actually happens when we introduce disclosure policies. So I wanted to just show this for the archival people out there. Now, if there are at this point questions already, Giovanna, you can probably raise them right now before I move on to the theory, and also we'll just continue.
I think it's my turn to take the questions. So
I
think that we have a line of questions now. So
there we
some
go.
of them from the first round. So first it's like Srivatsan. Sorry for the name. If you can unmute and ask the question.
Yeah, hi. Thanks, Andre. Yeah, thanks, Peter. Very useful, interesting so far. And I suspect I might be preempting what you're going to say, but since I have to hop off in about 20 minutes, I thought I might as well raise it. So based on my limited knowledge, tax assessment obviously is always at the legal entity level within a jurisdiction. And so are financial statements. So my question really is that any public disclosures of tax-related information, since it would necessarily be at the legal entity level, wouldn't they by design kind of conceal more than they reveal in the sense of what the true tax fairness of a group is? I mean, you know, even in jurisdictions, some jurisdictions there are within the same geography. There is a opportunistic tax management going on across two legal entities of the same group. So I'm not sure if this is being handled in your methodology somewhere, but I'm just a little bit keen to know this because you started off by mentioning the Australia example at the legal entity level, I think it was. Thank you.
Okay, thank you so much for your question. That's very interesting. I think I share that opinion or that observation, right? I think that from what I've read, firms have a lot of ways, right, to obfuscate and to manipulate, affect how even these tax disclosures may actually look like, even if it's mandated. But actually, this is really not, just restricted to mandatory tax disclosure. Actually, in financial accounting, this is also, and financial reporting, this is also discussed quite a lot. But isn't this kind of more like a glass is half empty, half full type of thing? So is it really good to say that we can therefore never learn anything about the underlying tax reality? I think as soon as you maybe agree that we can learn something, then maybe there's some plausible possibility there that it can do something. But I think that your question hopefully was more about the tax disclosure policies in general, right? Not necessarily one that we focus on. We focus on, I think, select tax information. And there we put a cautionary note. But I think saying in general that mandatory tax disclosure, that there's never something to learn in there. Well, I'm not sure whether you said that, but it seemed to me that, that you were very carefully going in that direction. That would be very difficult, at least. Let me put it like that. I would like to argue probably that the glass is perhaps half full, right, rather than completely empty. So I don't know if that.
Thanks, Victor. Thank you.
Okay.
Yes.
So we still have some questions. So Irene, if you can unmute, it's a question from the first round still.
Well,
Okay.
it's not so much a question. I'm a professor of international and European tax law. And I also work for the Department of Accounting in Groningen University, where I am a professor in tax accounting and tax control. And my focus on the one side in my profession of being professor of international European tax law is on this whole BEPS issue. So what exactly are companies doing? How do they try to avoid taxes? And on the other side, I'm presently working on a project for how are we going to do the tax auditing for the tax administrations. How can they get more information out of what is revealed by the companies, not only in their tax returns, but more real time. For instance, a code of conduct on what exactly is the tax strategy of a company, and what are the tax risks that companies perceive. And in this whole issue, from both sides, what I need to know is what exactly is a fair tax. So I wrote together with one of my PhD students, former PhD students, who is now associate professor in Leiden in tax, international tax, Irma Mosquera, an article about what exactly is a fair share. What is fair taxation? And what we found is that the OECD is basically the driver of the whole anti-BEPS initiative. They drafted guidance to countries on how to change their legislation. And they basically focus on the economic perspective of fairness. And the economic perspective of fairness is that you pay a tax where you add the value. So it's all about value creation. And perhaps that's something...
I'm sorry, Irene, I'm sorry to interfere.
Yeah, it's
Can I? Yes, exactly. We're on a side track, so maybe we can let Victor comment on that, and then we're just going to.
I just wanted to give Victor some guidance that he should look into the articles, and he should look into the concept of value creation and pay the tax where you add the value.
Great.
Because that is where the fair tax is. Pay the tax where you add the value. So it's not about countries where, for instance, the IP of a company is shifted to the real tax havens, where there is only the juridical ownership and not the economic ownership. There we see no taxes is paid. That is not fair. Some tax should be paid also on royalties, etc. If you want to discuss it, Victor, you're my guest. We met in Groningen. We're there.
So let's see with Victor if he's having comments, and then we have two more short comments, and then
All right.
Back to you.
Well, thank you, Irene. Yeah, and I remember meeting. So thank you so much for your thoughts. I think that we in the author team we also discussed the different methods that firms use and the European setting. I find it very interesting what you said about the work that you've been doing. That sounds fascinating, actually. Especially looking at what I think you said the Europe, right, or the OECD, what they consider fair. I think in our study we are more interested in not what Europe thinks fair, or the OECD, but what the public finds fair, and probably that's kind of the same, or that should be aligned in some capacity. But I think in the end, it will end up being quite similar to what you're saying. I want to make maybe one more small remark about where this fair share notion comes from. This fair share notion is something that we've seen in the public debate pop up, paying your fair share of taxes. And we've seen it pop up in for instance, some of the tax accounting literature. So that's where we picked up on this. And we think actually, yeah, the question is actually to what extent it is objectifiable. Now, but I do agree with a lot of the things that you said. I think that matches at least my perception, and perhaps we should elaborate on that a little bit better.
Great. So a short question from Ronald. Ronald, if you can please unmute yourself.
Yes, thank you. Good afternoon, everybody. My question is related to Irene's. It's also about the fair share spectrum. I believe there's two routes to be taken. You can discuss what is a fair share and then look at the debate, the value creation. But what I've been taught, where there's more consensus on the topic is what is definitely not a fair share, right? So maybe it's more recognizable to the public and legislators what is not fair. And do you believe that there's a function for public tax disclosures in this manner? So do you believe naming and shaming is still a valid strategy for legislators to use, even though there's maybe blurring of perceptions? If you could make it more extensive, the disclosure, maybe, right, the public disclosure.
Thank you so much for your question. That's a really good question. So unfortunately, I must remain in the scope of my paper. And that is that I can only say that we have a careful cautionary note about the use of select public tax disclosures for members of the public, specifically retail investors. We find that their perception information is actually can be hampered, right? When we have when we publicly disclose select tax information, such as corporate taxes in a primary jurisdiction. And we see that this has been a topic of debate. Now, if you would think about that more abstractly or more conceptually, this is not part of our paper, right, yet. So we try to be very careful, but I think what we need to ask ourselves probably is what indeed the function of these public tax disclosure is and for whom it is actually written. I think I also really find it interesting that Irene talked about audit. And I think it's very important that we make a distinction probably between select public tax disclosure in the form that we show here and more extensive forms. That's really the only thing I can say. I don't have answers to that because I haven't done any research besides this one yet. So this is my first paper, maybe in the next paper. But I find it a very important question. I have been thinking a lot about it, but those are just opinions, right? So thank you so much for that.
Great. And just one more question before we move forward. The last question from Mamoun. If you can please unmute.
Yeah.
And...
Yes, Mamoun speaking. Hello.
Hello.
Hi, everybody. I want to thank you for this seminar. I'm a PhD student in Bucharest. Now I'm in Jordan in the Middle East. I want to ask about something about disclosure policies of taxes, because if there's a high volume of the taxes in country like us, we have 30% of income taxes for the company. They try to didn't pay that amount by using some accounting policies, something. In the end, they didn't pay the amount that the government put on that company. So in the end, after 2 or 3 years, they deducted it as a part. They cannot pay that amount, and that if we return to the disclosure or policies of the taxes, I think if there's a high volume of taxes, the managers didn't want to pay that amount. And if they make a disclosure or make it as announcement in the newspaper or something, that not be good for the company and for the shareholders. Do you think it's a good or bad thing about its effect on the disclosure policies or not? I don't know.
Okay. Thank you, Mamoun, for your question. I think it's an interesting question. I'm not an expert in this area. If I interpret your question correctly, you're saying that different jurisdictions have different statutory tax rates, and if a statutory tax rate is very high, then maybe managers or firms feel that they actually are allowed or should be able to avoid taxes more strongly, and perhaps even use more aggressive means compared to, for instance, in a country where the rate is much lower. I don't know anything about that. I do think that perhaps perceptions in a country change, so maybe collectively. So for instance, if a country finds it very important to tax firms heavily and the public agrees and everyone wants that, then that is the status quo, right? And in a country where they feel that isn't that important, then you see it shift. So I think the results that we show should not really be, that's because it's an experiment, should not really be dependent on that. But if there is, of course, an inefficiency in that, then maybe, I don't know, politicians should lower the statutory tax rate. So I hope that answers your question. Thank you so much.
Great. So we'll let you advance, and we'll come at the end with more questions. Thank you.
All right. So now I'm going to talk a little bit about our theoretical prediction. So basically, if I can continue. Yes. So basically, the starting point for a theory is as follows. Ideally, retail investors, they can look at, for instance, financial statements, and they can find a tax rate reconciliation and get some indication of the tax avoidance methods that are used, some indication. Of course, it's not perfect, but they get some feel of what is going on with the firm. And that's basically the starting point for us. Now, this is, of course, somewhat costly. There are some processing costs involved when it comes to retail investors, and that's important, which you will see later. But this is possible. Now, we find actually, there's some research on that studies how the public judges tax avoidance methods. The public, which also means retail investors, how they view different types of tax avoidance methods. And it finds actually that more aggressive ones, which is this term again in the literature, such as profit shifting, right, rather than R&D tax credits, tax loss carryovers. So the more aggressive ones are viewed as more unethical and less socially desirable. So we could probably argue, plausibly assume that more aggressive tax avoidance methods, they are perceived as less fair. And actually in our data, when we look at our experiment, we afterwards ask participants, well, what do you think of this method? Do you think it's, what do you think the fairness of this tax avoidance method is? And we indeed find a strong significant difference between the perceived fairness of the methods directly in an ex post questionnaire. So this is not our experiment, it's just a validation. We do see in our data and in our sample that the perceptions match with this assumption and what the prior literature shows. Now, going back to the starting point, right? Ideally, this is what investors, retail investors could do. Now, we rely on attribute substitution theory to predict how the perception formation process may be affected by the public tax disclosure. How does this work? Well, when public tax disclosure of select tax information, such as corporate taxes and limited bottom line numbers come in, this actually introduces a piece of information that is extremely salient and extremely accessible. And attribute substitution theory predicts that that will obfuscate the underlying tax avoidance methods that are actually responsible for these numbers and this limited, this select set of information that is publicly disclosed. And that means that the fairness perceptions will largely be responding or focused on these corporate taxes that are publicly disclosed, while they were over-rely on that, right, and kind of lose sight of what is actually driving these numbers. Now, there are three conditions under which this occurs according to attribute substitution theory. So this doesn't always happen, right? This happens under some circumstances. And these three conditions are as follows, and we're going to check them. The first condition is that the target attribute must be relatively inaccessible. Now, the target attribute here are these underlying tax avoidance methods. Learning about them, trying to uncover what they are and what a firm is actually doing, and how aggressive they are. And we see, actually, we've seen before that retail investors must go through some length to actually get to these methods, right? They must access, at best in the US, maybe a financial report, and they must go to the tax rate reconciliation. So it's relatively inaccessible, this target attribute. So that condition is met. The second condition is that there must be a relatively accessible heuristic attribute. Now, the heuristic attribute here is the select tax information that is publicly disclosed as part of this disclosure, which are the corporate taxes. Now, we see that this is actually relatively accessible because this is what is being collected and structured in Australia, for instance, in the case of tax authorities. It is put out there on a yearly basis. Maybe some of the media picks up on it. So, and then investors swamp to this information, and and the general public, by the way, and they will have much easier access to this information. So that condition is also met. The third condition is that the substitution must not be consciously rejected. Now, this is also met because we don't expect that retail investors, or in other words, inexpert members of the public, that they consciously realize at that point that, oh wait, there may be more going on, because they're not experts, they're inexpert. Perhaps if you are a tax expert, you may probably think about that and consciously reject the substitution. Now, based on the poll that I just saw at the start, where all of you flocked to firm A, when I said answer the question if you can, right? Maybe also comes about there, but I'm not really sure. I was kind of tricking all of you in, giving that answer. So that was not a fair test, but you can see that there are situations. My point is, in this case, or for inexperts, they will probably not consciously reject substitution. You may think, oh wait, this attribute substitution does not happen. I mean, people think about this carefully and all these things. Well, it may be more prevalent than you think. Well, it is more prevalent than you think. I actually, when I go out every day, I see almost an example of it. And perhaps recently with the COVID-19 crisis, we also see examples of it. So you can think of the severity of the COVID-19 crisis as the target attribute. And one of the heuristic attributes that I've seen, at least at the start, pop up quite frequently are the number of COVID-19 defined, measured COVID-19 infections or new ones in a particular country. But there's probably a lot more information and measures that are probably quite important or that are underlying, you know, this information. So I think, you know, and they can get kind of blurred sometimes. So I think that attribute substitution is a lot more prevalent than you may think. Now, why is over-reliance so problematic? Now, if this happens, then corporate taxes in firms' primary jurisdiction may inaccurately capture the underlying tax avoidance methods. How? Well, these are the extreme cases, obviously, but this is how we illustrate how and whether this can happen. A firm may be shifting profits, but it may actually pay the statutory tax rate, right? So an unfair firm looks like a fair firm. At the same time, a firm may be using perfectly legal means, like and perfectly commonly accepted means to lower the tax burden. For instance, R&D tax credits, right? Which means that you get credits for lowering taxes by investing heavily into operations in a particular country. But because of that, it may look like an unfair firm because its tax rate is below the statutory rate in a country. Thus, keeping the amount of corporate tax avoidance constant, right? Let's assume that both the good and the bad guy are avoiding the same amount of tax. Public disclosure of these corporate taxes decreases retail investors' tendency to differentiate between these firms. And that is our main prediction. And that looks a little bit like the following graph. So for a less corporate tax avoidance method, we see that people should move more towards interpreting a fair firm as an unfair firm and a unfair firm as a fair firm. So this is basically what we predict. We predict a lower difference, so it's blurred in terms of fairness perceptions when public tax disclosure in this form is introduced compared to its absence. Because in its absence, we think that investors are more likely to kind of look at the underlying tax avoidance methods. So this is our main hypothesis. This is the formal hypothesis. So the negative effect of tax aggressiveness on tax avoidance methods on fairness perceptions is smaller when corporate taxes are publicly disclosed compared to when they are not. Back to you, Giovanna.
Thanks. There is one question from Anna that we can quickly take, and then because I'm cautious of time, I think you should move on to the experiment.
Mm-hmm.
Make sure we get to
we'll have half an hour, right?
Yeah, yeah.
Okay.
But we may have another round of questions. Anna, do you want to ask your question?
Sure, I can. Hello. The question actually refers to the tax planning and whether you address tax planning or modeling methods in terms of the reducing taxes, whether it has any impact on the disclosure.
Let me try to understand the question. Maybe you have to explain a little bit more. So you're saying whether the underlying tax method impacts the type of disclosure or how the disclosure looks? Or?
Tax planning methods like modeling of taxes.
And what's your question exactly? I don't understand your question.
Whether you address in your research these issues, whether the company uses tax planning methods, and whether this affects the disclosure policy.
So in terms of the policy, we manipulate it ourselves. So we run an experiment, so the policy is unaffected by anything besides us. So the policy that we manipulate, and we do that for a reason, because we want to have a causal effect. We want to see how the perception formation changes. But perhaps what you meant is whether, like, how that what is disclosed in the public policy, how that is actually affected by the method. Well, what we do in the experiment, which I will explain subsequently, is that the type of information that is disclosed in the policy that that is affected in some kind of way, and that's kind of what I explain here, is that like an unfair firm, you know, may look like a fair firm, right? Because because in a particular jurisdiction, there may be this select tax disclosure of corporate taxes, and it looks like it's just paying the statutory rate, but it could and maybe even should probably have paid more in absolute amounts. Now, the second type of firm, this is the other extreme probably, is a firm that pays taxes below the statutory rate, and we've already seen quite a lot of examples why that may be quite acceptable, right? But with this public disclosure, it kind of looks like it's an unfair firm because indeed it's paying, you know, very few taxes, and that's exactly perhaps in Australia where we see some examples where this could go wrong. So I hope that answers your question.
Yes, thanks.
Is there another question, Giovanna?
Oh, I think you can go on for now. Thank you.
Okay, thanks. All right, so let's get to the experiment. This is an overview of the experiment. This is how we try to test our hypothesis. We first have some instructions at the start. Then we introduce a case with a hypothetical firm, and we manipulate both the tax avoidance method and its aggressiveness and the presence and absence of the public tax disclosure policy, right, of corporate taxes. Then we measure fairness perceptions of individuals, of our participants, and then we measure the investment perceptions. You can actually test our experiment yourself by going to taxexperiment.herokuapp.com. Now, be aware if you click on one of these experiments that we feature in the paper, if you click on one of the links, you're in one of the treatments. So we have manipulated treatments, so be aware of that, right? So you may be in a public tax disclosure treatment with some methods. It's just one of the examples. Now let's start with the instructions. We provided some information to participants. We featured a hypothetical company headquartered in a country that the participants were a citizen of, which had a statutory rate of 24%. However, we also told participants the tax that it effectively pays may be different. And we explained two tax avoidance methods to them in the simplest way that we could. So on the one hand, we used the example of R&D tax credits, right, which deduct the amount they invest from business operations from the taxes that they have to pay in a dollar-to-dollar amount. And we used a profit shifting method, which is the more aggressive method. So this is the second method people perceive as you know, unfair or less fair, and the first example people typically perceive as more fair. Now let me continue. So next we elicited a dependent variable. So that means we asked them, to what extent do you think that this company is paying its fair share? And to answer this, participants needed to hold and press this financial report and look at a simplified excerpt of a financial report. Now, what does this look like? This looks as follows. So basically, they get a consolidated information, right, simplified about some financial information and the consolidated corporate taxes, and they get the tax rate reconciliation. And here they could figure out or get some impression of the tax avoidance methods that firms used and their aggressiveness. For instance, this tax differences due to foreign profits could kind of indicate, well, okay, this firm is actually could be shifting profits. And the investment tax credits would indicate that this is actually the primary method or the reason why it pays below the statutory tax rate in country A. Now we manipulated this So here on the right-hand side, you can see that either this firm used, shifted profits, or this firm used tax credits. So it's either or. And what is very important is that on the consolidated level, we try to keep the ETR, the effective tax rate, so the extent of corporate tax avoidance, constant across all conditions. Now, why not a complete financial statement, you may ask? Well, in an experiment, you have to have a simplified controlled setting, because what you want is you want to get rid of noise and factors that you're not interested in. And that's actually part of the power of experiments. So if we had put a complete financial experiment here, complete financial statement here, people would have responded to all kinds of other things in the financial statement, and we would have just have lots of noise in the dependent variable. So we use an excerpt which represents, I think, all the information that is relevant in our conceptual setting. So this is actually all the information. Yet there should be a processing cost, right? So people should find it a little bit annoying to get to this information, because this should be less accessible or difficult to actually access. That is why we use the button. And this button, basically, they have to press the button and they have to hold it in order to look at it. And afterwards, we left a feedback box, which is customary with these type of participants, so they can report whether there were problems with the experiments. And some people actually told us, well, look, why did I have to hold on this button? It was kind of annoying. So it is quite interesting to see that our feature to make this a little bit costly in terms of processing and accessing and processing this information actually worked. Now, the second manipulation, so the first manipulation was the tax avoidance method. The second manipulation is that is the presence of public tax disclosure. And this is where we basically disclose the following information about the corporate taxes paid in country A. So this is the tax credit firm. Well, first you could see that this is more accessible, and the information under the button should be less accessible, right? Because this is on top, it's immediately there. Now the R&D tax credit firm would actually reveal this information. So here you can see that it pays around 11%, or what is it? Yeah, 11%, which is below the statutory tax rate of 24. And the profit shifter would reveal this other information, which is actually 24%. So this looks like a good guy. But if they would have looked below the button, then they would probably see that things, may actually be different. Now, we recruited participants on Amazon Turk, which people have frequently used. These participants people have used as proxies for retail investors in the past. We use quite commonly accepted selection criteria here to make sure that people were paying sufficient attention and were actually motivated to take part. So what do we find? Well, we find support for our hypothesis. Actually, the difference in difference becomes less. So that means that investors, retail investors, and our participants more directly, they differentiate less among corporate tax avoidance methods in the presence of this public tax disclosure. So that means actually that this tax disclosure actually hampers perception information. For people who have paid careful attention maybe to our prediction, is that you see that it's largely driven by the bottom effect, by the bad guy actually, or the unfair tax firm appearing more fair, and actually less so by the fair guy appearing less unfair. So it seems that in our sample, at least, firms are a little bit given the benefit of doubt, but as soon as they look good, then they're good, then it's fine. So people don't really look further. So that provides a slight nuance to our theoretical prediction. I'm going to skip this for the sake of time. Maybe we could, at this point, Giovanna, go to some more questions if there are any.
Yes, there is a question from Ronald again.
Okay.
Hello. You say that for the experiment to work, the investors have to not consciously reject the substitution as the effective tax rate, I think, as tax aggressiveness. But within the same disclosure, the tax authorities are always warning consumers of the disclosure that the public tax disclosure itself is not sufficient in measuring tax aggressiveness, and that you need to look at intra-company transactions, financial statements, etc. The less accessible information, right? So, can we still assume that investors or retail investors are not sophisticated enough in their judgment if they are warned beforehand, even though they are no tax experts?
Could you repeat the question one more time?
So,
sorry.
Okay, so we assume that retail investors are no tax experts.
No, but I mean just the last part of the question.
Yeah.
I think I got the start.
Can we still assume that retail investors are lacking refined judgment if they are warned beforehand?
If they are warned before, okay. So specifically about the warning, that's very interesting because, you know, it's almost like saying, okay, we have this public tax disclosure for you. And they're saying, yeah, but it's actually, you know, it doesn't matter at all. So it's kind of weird. It's kind of undermining your own public tax disclosure. That's very interesting. So what's the use of this tax disclosure then? Maybe it says something. That could be. And I think that in our case, you know, in theory, these limited select tax disclosure could have some interventional value, but I think our message is it could also be exactly the opposite and actually mislead investors. Yes, and that's exactly part of this public tax disclosure. So I think it's very interesting that you say that, but then what will members of the public, what will they do with this? Because then they kind of, well, should I rely on this information or not? What should I do with it? So it makes things a lot more ambiguous.
I'm
a bit surprised by that.
I'm doing a research on the informational value of public tax disclosures and also the voluntary tax disclosures. So the question is if there's any information value at all, but if you look at research, there's definitely effects and investor perceptions change. So we can safely assume that it is being consumed. But then you ask yourself, does the public tax disclosure, is it just a variable you need to take into account? Even though it might not be sufficient on itself to judge the tax aggressiveness of a company, it might contribute to your perception. But you said for your experiment to work, the investors need to not consciously decline or reject the substitution, right? Yes. And I think if they are warned beforehand, then we cannot just say that they are no experts, because they should have some sophistication in their judgment. Okay? Maybe, but I don't know. It's a bit hard.
Yeah, I mean, I would probably argue then, you know, if you just warn them, don't use, or if you're undermining your own public disclosure, probably you should not have the disclosure in the first place for this group, right? Yeah, but that would be probably my gut feeling.
But in the Australia example and almost any other, they are warning investors that you cannot substitute, right?
Yeah, I find it a very difficult question. Maybe we could, I have to think about that, whether a warning, I guess maybe it does something, but I don't really know what you achieve with that. It seems like a very strange thing to do to me, that you're undermining this very thing that you're doing.
Yes, definitely.
That makes little sense to me.
Yes, it's a bit of a paradox. Yeah.
Thank you.
Good. We have another nasty question coming from Joachim.
Nasty.
Well,
okay.
Naughty.
Good. Very good.
So sorry. So I'm not sure whether it's nasty, but I wrote it down. So I was wondering whether this can just be driven by some limited attention kind of problem. So if I understand this correctly, you provide more information to your subjects under the public disclosure treatment, so they get more information, and this of course could explain why they put less emphasis or weight on the financial statement information that you provide. So if I would like to play the devil's advocate, if you would give some other completely irrelevant information, but that the people have to process in this Mechanical Turk setup anyhow, would you also expect an effect?
Very good question. I would like to maybe refer back to the previous question, where basically there was a public tax disclosure that was just undermined, so that would be irrelevant, right? I mean, to me, that would probably have an effect, but that would be a bit meaningless. So I think it's a good point. I guess just having something there maybe is part of the effect, but ultimately.
Yeah, so sorry for interrupting. I just want to keep this short. The reason why I bring this up is that in an experimental setting, of course, you can limit the amount of information that is out there, right? But in the real life setting, people have, you know, the information overload is paramount. So the investors always have access information and they have to pick the information that they look at. And to me, this is a somewhat different, let's say, somewhat different problem from what you are having. So I'm not saying that anything is wrong with your experimental setup. So you have to make these choices. But just in order to understand and interpret your findings, I think it's worthwhile thinking about this, at least for me.
Yeah, well, I think that the setting is stylized and simplified, and that helps us think about these kinds of issues because it makes it a lot simpler. The information that matters in this setting is much simpler than in reality, and that's true. But the only thing that is important here, I think, is that we have information that is a little bit more costly to get at, right? That would give people a good impression about or a decent expression about the underlying tax avoidance methods. And there's some more accessible information that could paint the wrong picture. And I think that we can manipulate that, and we see that that works, right? And I think that that is, you know, and then you can debate about, well, how much information and about, you know, all the other factors come into the experimental setting. And yes, I agree, all of these things matters and they may change things, but the only thing that we're interested in, and that I think is relevant for this causal effect, right, is can this lead to this misperception? And that's what we kind of show. So I think, so I agree with you, but I think also that the limitations of the experiment also is at the same time its strength.
Let's see, thanks.
So let me, do we have another question or shall I try to wrap up?
I think you could try to wrap up and then if we have a minute, we can take another one. Let's see how it goes.
All right, this is very interesting because I was so afraid that I wouldn't have enough slides, and my co-authors kept telling me, you have too much slides, you have too much slides. And I said, no. So, and here we are. So just to sum up, I'm going to the
But you still have conclusion. 7 minutes. So if you want to
Yeah, I know, but I have, I know what I want to show, I think.
Okay, cool.
So first thing I want to talk about briefly is is some of the extra experiments that we do. So maybe before that, one more thing. So we find that there's that the investment, the fairness perceptions are actually affected, right? They're affected by this disclosure, and we also find that they subsequently affect the investment decisions. So the investment perceptions of retail investors. So it seems to us that also this could have important effects also for how retail investors kind of behave in the capital markets. Although we cannot speak to that directly, of course, only through the perceptions that we elicit, which are these investment perceptions. Now, why this is the case? This could be for many reasons. Maybe it's because of intrinsic reasons. They just really care about fairness and about firms paying their fair share. Or it could also be because of tax liability, or they think that unfair firms will, for some reason, will be brought into court in the future, or some other reason. So that's one other thing we find in our main experiment. Now, we run some other experiments, some extra experiments. And one of these experiments is, do the results hold when the consolidated effective tax rate is actually really low? So that means that now we repeat the experiment, but we just, you know, rather than having kind of a moderate amount of corporate tax avoidance, we now actually have extreme corporate tax avoidance at 1%. And we find actually quite similar results. Now we find that the whole result is kind of shift downward because both of these firms now, regardless of the method, are really massively avoiding tax. But we still qualitatively find the same result. In the second experiment, we kind of really do experimentation. And this is where we try to look at a policy that mandates public disclosure of select information, but on a country-by-country basis. And that means that we provide participants with basically the corporate taxes it paid in any jurisdiction that they're active. Now, what we actually find, if we do this, is we find that it doesn't really necessarily help. Right? We find that it's slightly worse than the baseline, which would mean just looking at the financial statement and actually looking at the tax rate conciliation. We find this quite a surprising result, actually, quite interesting, because in theory, with on a country-by-country basis, they could kind of see what is going on with these taxes, but we still find that going into the financial statement in this experiment and looking at these, whether it's a foreign rate differential or investment tax credits, that works slightly better. Now, just to wrap up, I have 3 more minutes. The main conclusion of our paper is that public disclosure of select tax information, it can blur retail investors' perceptions. They can decrease their tendency to differentiate between firms who are using different tax avoidance methods. This process impacts their fairness and investment perceptions and is robust to different degrees of corporate tax avoidance. We also find that a country-by-country basis does not necessarily seem to help. Policy implications, well, they can have the opposite effect as intended, at least in the case of retail investors. Governments, they are thinking about these types of policies, and basically what that will mean is that it could, to some degree, make adverse selection problems worse, and it may obfuscate the underlying tax reality. So we just provide in this version a cautionary note. What about more extensive tax disclosure policies? Well, of course, this is also seems to be still on the radar, but this is also a century-old debate. Think about a company's complete tax return. Why don't ESG investors actually do that? This is Professor Rajgopal in the US who wrote in Forbes about that. But then we get back to the proprietary cost information. And I think it goes a little bit into the direction where we think that at least for inexpert members of the public, these types of disclosures are quite tough cookie to crack. Now, limitations, then I'm actually finished. There may be other meaningful public tax disclosure policies that we not cover, of course. And this, there are some opportunities for future research there. What about some other forms? Maybe they are better at it. Maybe they do work. We cannot speak for the causal effects on the perceptions of more sophisticated investors and experts, right? We don't know about that either. And I already talked about the financial statement during the experiment. So I want to thank you, all of you, also for your questions. I found that they were very interesting, and also thank you the organization for this opportunity. And if there are more questions or suggestions afterwards, you can always send me or my co-authors an email. So thank you so much.
Thank you very much, Victor. Virtual applause, I guess. Thank you, everybody, for your questions and for attending the seminar. Thank you, Andre, for helping out today. Just before we say goodbye, I hope you will join us again next week. We have Chris Chapman from the University of Bristol, which is a great place, by the way. The paper is already available on the ARC. So do please have a look at it and register for next week. The registration will be open after 6 p.m. Central European Summer Time today. And for those who have signed up for the virtual reception, we're going to be there in a couple of minutes. Thank you. See you next week.
Perfect.
Thank you very much. Have a nice weekend.
Yep, same here.
Thank you.
And if you think about joining the virtual reception but have not registered, I think you can still squeeze in. So just, click on the link. You should get an email, and then you can join us at the virtual reception. Okay, see you next week. Thanks, everybody.
Bye, everyone. Thank you.
Thank you.
Thank you.
You're welcome. Okay, Joachim, have a good trip.
Yeah. See you. Yeah, I will come to the virtual reception real quick.
We need.
Okay. All right.
We need
I will now be out
to open the reception. So.
Yeah, exactly.
Right,
Let's
good.
move over to the reception room.
All right.
Okay.
Yeah,
See you in a bit.
See you.
Joachim, if you go without ending the meeting, I think I can stay one more minute.
Okay. I'll just leave meeting then. Okay. So I assign you and leave.
Bye, Giovanna. I'm going to head over to the reception.
Yeah, see you later. Thank you, everybody. It was really great to have you all.